Hi everyone, Michael here. In this video, we're going to be going over how the Federal Reserve could start tapering its quantitative easing and start lifting interest rates much sooner than they've been saying. This is something that I've been saying is coming. Many people didn't believe it. They say no, the money printing is going to go on forever. They can't afford to lift interest rates. But now there is starting to be some division in the Fed. There's starting to be some fighting in the Fed. And Kaplan, the head of the Dallas Fed, says it's time to start talking about tapering. So in this video, I'm going to break down exactly what he says, and this is going to give us some hints to what's going to be happening in the economy and in the markets in the future, because what you have to know about the stock market and the housing market is they're not always correlated exactly with what the economy is doing. Like what we saw in 2020 when the economy had one of its most severe downturns, but the stock market and housing market boomed, and that was because of all the quantitative easing that was done. That was because interest rates were dropped. So even though the economy done bad because of the cheap money, and that's what's really lifting market sentiment at the moment. But once the punch bowl gets taken away and they start tapering that quantitative easing and start lifting interest rates, even if the economy is booming and even if unemployment rate gets to a really good rate like 4%, and what you have to know about the unemployment rate is even if you're working an hour a week, your class is employed, and also inflation is going up much faster than wages. So even if you do have a full-time employment, or if you do have a full-time job, it may not be enough to survive on. So that's why I think the unemployment rate isn't really a true indicator of how strong the economy is and how much disposable income families have. Okay, so let's get right into his statements about what he thinks the Federal Reserve should be doing and his calls for what they should be doing. Okay, so he says there are excesses and imbalances in financial markets. And that's exactly right. The stock market is now 200% of GDP. The housing market is skyrocketing out of control. They're buying a lot of government treasury bonds, but bond yields are still rising. Let's have a deeper look on what he's got to say on these topics. Okay, so Dallas Fed President Robert Kaplan said Friday that he thinks the central bank should begin discussions on slowing or tapering its $120 billion of monthly asset purchases. And that's something I completely agree with. Why are they still buying $40 billion of mortgage-backed securities when the housing market is booming? And a little theory that I have is why they're still doing this is because maybe there are still some bad subprime mortgages from 2008 that the Federal Reserve has to continually to keep buying up, and also with all this mortgage forbearance and all these people not paying their home loans, then there may also be some more bad mortgage-backed security or bad mortgage debt derivatives being created. And so nobody really wants to touch these mortgage-backed securities because they don't know if it's a good loan or if it's a customer that hasn't been paying their mortgage for a year. But when there's no more buyers, of course the Federal Reserve comes in to save the day. He says here, at the earliest opportunity, I think it'll be appropriate for us to start talking about adjusting those purchases, Kaplan said during a talk with Montgomery County, Texas Chamber of Commerce. And that's funny because Jerome Powell is saying we're not even going to talking about lifting interest rates or tapering. And here's Kaplan at the Dallas Fed saying, no, it is actually time. And I think that's what the people are thinking too. The stock market is skyrocketing out of control. The housing market is booming out of control. Inflation risks are rising, which we'll get into what he says on that in a moment. So why the heck are they still going at full steam ahead with interest rates at zero and with all this quantitative easing and money printing if the economy is booming? What I do think would happen if they stopped buying government bonds is bond yields would skyrocket and the US government wouldn't be able to afford to repay the debt if interest rates got back up to 2.5% or 3%. So that's the real reason why they can't take their foot off the pedal. And it's funny because Jerome Powell keeps saying, no, we can't do anything until we have substantial progress towards our goals. Well, Kaplan's saying we've already had substantial progress to our goals, and we may actually have the risk of unemployment getting to 4% by the year's end. And it's funny how they say that's a risk when that's actually a good thing that unemployment's dropping, but it's actually a risk for the financial markets because then that means they're going to have to take the punch bowl away and start lifting interest rates, because the Federal Reserve and all the central banks around the world were saying, no, we're not going to lift interest rates till 2024. But now many economists are starting to change their tune and saying that they think interest rates are going to actually start rising in early 2022. And this is what he said. So Kaplan on Friday staked out a different view. He reiterated his expectation that the Fed will need to start raising interest rates next year, more than a year earlier than most of his Fed colleagues anticipate. The Fed has promised to keep up its current pace of bond buying until the economy makes further substantial progress on its two goals. And listen to this, like I was saying earlier, Kaplan said Friday he now expects to reach the Fed's hurdle for beginning to reduce bond buys sooner than he had thought even just a few months ago. There is an upside risk to his own forecasts of a 6.5% US GDP growth this year, he said, also predicting unemployment unemployment now at 6% would fall to 4% by the year's end. And the data released this week said that the US economy grew at an annualized rate of 6.4%. So the economy is rebounding much quicker than anticipated. So that means the money printing is going to have to die out much quicker than anticipated, and interest rates are going to have to go up much quicker than anticipated. And on our favorite topic here, inflation, because we all know inflation is much higher than the Federal Reserve is reporting, but even the official CPI numbers of inflation is skyrocketing and it's going up much quicker and much higher than they thought. And he comments on inflation right now. So on inflation, Kaplan, like Powell and other Fed policymakers, says he expects inflation to surge in the coming months, simply in comparison to last year's very weak readings amid nationwide lockdowns. So of course there's going to be a base effect with inflation over the next few months because inflation was much lower last year, but it is going to be higher than they expected. And listen to what he says on what it's going to be after that base effect. He predicted readings of 2.75% or more. Some of that pop will reduce in the fourth quarter, he said, but he did not characterize inflation as transitory like the Fed Jerome Powell said. So he, unlike Jerome Powell, doesn't think it's going to be transitionary, and we're seeing commodity prices like copper, lumber, steel, oil, corn, coffee. So all commodities are skyrocketing, and commodities where you need to build things and make things are skyrocketing. So that means consumer goods will start to rise. There's just going to be a delayed effect. So even though there's going to be a base effect of inflation over the next few months, with all these commodity prices skyrocketing, that means after that, prices will still continue to increase because the cost to build everything will skyrocket. And even in the CNBC article, they said that the cost to build a home is going to increase by $36,000 because lumber prices are skyrocketing. Listen to this. He said some of these base effects will go away, but that's not to say there aren't still strains, he said, pointing to an expected surge in consumer spending, supply shortages, rising material costs, labor shortages, and fiscal spending. So everyone, everything that we've been talking about in this community here, it's all starting to play out. A year ago, they said, no, you're crazy. This is never going to happen. Inflation's not going to happen. They're not going to lift interest rates. They're not going to turn the money printers off. But now it's time to face the music. We've had the good times. It's been fun with this cheap money, with this money printer go burr, with stocks skyrocketing, with the housing market go up. It's been all good. But now it's time to face the music, and it's now time to pay the bill. So what does this mean for you and me? This means, like I've been talking about, the money printer is going to turn off much quicker than expected. Interest rates will go up much quicker than anticipated. Inflation could get out of control. And what that would mean for the stock market, with the stock market at all-time highs, if interest rates just go up 1%, the stock market could come falling down 15%, and especially these stocks that have high price-to-earnings ratios, value stocks will perform better, I think. Especially going over history, value stocks do tend to perform better during recessionary times. And again, with the housing market, with people paying 30, 40, 50% over asking price, well, guess what? They're going to have a rude shock when interest rates rise 1%, because there's a lot of people that are trying to get in the housing market now and hoping to flip it for a quick profit next year. But if you're overpaying 30, I've heard some buyers are trying to get offers 50% above asking price. If you're paying 50% above asking price next year, when interest rates rise, when inventory rates rise, when the FOMO gets taken out of the market, guess what? Your home is only worth what a buyer is willing to pay. So even if headline figures don't say that house prices have fallen 50%, if you're paying 30 to 50% over asking price and interest rates rise 1 or 2%, you could be down 50% underwater next year. So everyone, I urge you, don't just listen to the mainstream media statements, do your own research, always look ahead and think for yourself. So everyone, what's your thoughts about this topic? Let me know down below. For all my loyal viewers and subscribers still watching, you're awesome. I hope you enjoyed the audio. I've got a kind of different setup here. I'm using the webcam and I'm using my Blue Yeti mic, because the lav mic I was using in the last video, the quality is not that good. So I hope you are enjoying this mic's quality, and it is nice to tickle those ears and give you some ASMR whispers. Just kidding. Thanks for watching. I'll see you all in my next video. Bye for now.